All right, welcome back. Today we have another stock analysis of a very interesting company with some interesting things going on with the stock right now. The stock dropped pretty much to $4 or $5 and now it's back up to $343, and that is Carvana. Now, Carvana is a very interesting story because of the popularity it had with customers. However, just because a product is great doesn't mean the business is great. Doesn't mean the business is profitable and generating cash flow, even though you enjoy the product. So we want to take a dive into this company to see what's going on with the fundamentals. What are the numbers of the company, the actual results of the business telling us, and does it explain the crazy increase in stock price over the past year or so? So let's take a look at Carvana. Looking at this chart, look at this amazing drop just for this stock to kind of stay flat for about a year, and then with a sharp incline from about $5 a share in 2023 to about $343 right now. That is an amazing increase. So again, not often do we see a company drop this low, this fast, and then come back up like this. So this is an amazing chart we're looking at. Congratulations for those who were able to get in at this low point and ride that wave up. Right now, this company is about $40 billion in market cap with the beta of 3.6. So it means it's very volatile compared to the overall market. So let's dive into the fundamentals and learn about the company to see, does this increase make sense, or are people pretty much waiting to lose a lot of money by investing in a stock that's this overvalued? So let's go into revenues. Looking at revenues, the business segments, how are they making their money? 89% of their revenues comes from selling their used vehicles. About 11% comes from the products and the services. So this is some of their loan servicing that they have for their customers. Going straight to the revenue trends, let's look at this. 2015, we're at $130 million. 2024, they ended at $13.6 billion. So pretty solid increase. We see they had an explosion here from 5.5 to 12.8 billion from 2020 to 21. I will say COVID has something to do with this. And we have 1 year of negative growth here. So we have down 20% in 23, but they bounced back with 26.9% growth in 24. Looking at the gross margins after they deliver the product to the customer, how much money is left over. We go from 1 million to 2.8 billion in 24. So 21% gross margin. An increase in gross margin, definitely, when you're looking at 1% and you're ending at 21% here. So margins, as far as the percentage of those margins, are going up in the right direction. Not as strong as the revenue. So let's look at this chart here. This shows us that the revenue is trending at a lot faster pace than the gross profit. So what is this saying? This is saying that revenues are going up as the price of the products are going up. So they're able to charge more for the products, but you don't see gross margins going up the same. So they're not able to push this cost to the customer. So when these increased revenues are coming up, they are covering costs that are coming in with the increased prices of vehicles, but they're not able to make a profit, or I should say more of a profit off of that. So yes, the cars are becoming more expensive and they're able to charge the increased cost, but they're not able to avoid absorbing those increases costs themselves. So that's how I interpret that chart. So going to profits, how much money is left over after they covered all of their cost? We have losses all the way up to 23. So they've only been profitable 2 fiscal years. And though they've been profitable, the profit went from 450 million down to 210. So a negative 53% decrease from 23 to 24. So they are profitable, but the profit isn't very strong, not consistent, and is heading in the wrong direction. You had 1 year profitability, then your profitability dropped over 50% in the subsequent year. So that is not a good sign. So heading over to free cash flow, let's look at this briefly. Looking at free cash flow for Carvana, negative 67 in 2015, continue to have losses, major loss in 22 and 21. Then we have 716 and 827. So cash flow is moving in the right direction. Again, not a long period of profitability, only 2 years, but they are profitable in the last 12 months. Looks like they're trending to be profitable again. So could be a good sign, could signal a turnaround for the company, which could explain the increase in stock price. But personally, I'm not seeing it so far. So let's look at debt to free cash flow. How much debt do you have on your books and how fast can you pay off that debt? Comparing that to the free cash flow you have, that determines how fast you can pay it off. We want companies to be 5 years or less. Let's see where they are. Very bad position. Of course, all of these years of negative free cash flow where they're burning through cash and they're not generating a profit, they're not making money that can pay off their debt, even though their debts are increasing. It's down a little bit from 22. We're at about 5.7 billion right here. But as you see, we've only had 2 years of positive free cash flow that would enable them to pay off the debt. So in order to pay off this debt, they're going to have to do some restructuring, which they've done over the past couple of years, or bring in money some other way. If it's not through profits, it's going to be through some type of equity funding where they're bringing in more shares. And looking at the shares outstanding, because they don't have a dividend, so we'll skip straight to there. You see, that's exactly what they've been doing. So we want to see this trend go down and not up like this. Now, here's a reason. Well, there's two reasons why this could happen, and it may be good for the company, not necessarily for the shareholder, but for the business as a whole. So as you see, since 2019, they've been selling shares to bring in cash so they can continue operations. As we saw, looking at the profits, they're not making money most of these years. So how are they staying in business? They have to bring in cash somehow. It's going to happen through debt or through equity. And as we see, they've been doing it both ways. So this is happening because they need cash. And also when the shares of a company is well overvalued, a company will sell some shares to bring in extra cash to run for their operations. But that's something that doesn't really happen year after year. It's typically a one-time thing for stable, profitable businesses. But as you see, every year they have a trend of bringing in shares. And each year that they do this, you as a shareholder, your shares become less valuable and diluted. So we don't like to see this, but we understand a newer company is going to do this to bring in cash and keep the doors open. So that's what Carvana has had to do. So if you see that the cash flow is positive over the past couple of years, it's not necessarily from profit. It's from actions like this. So let's look at economic value added. What's their returns on capital compared to the cost of capital? I want to know how much money you're making on the capital you have, the money that you have through debt or equity to run your business. And I want to know what's the cost of you holding that money. So not looking too good for them. They have, again, only 2 years of profitability. So looking at the last 5 years, they're averaging a negative 5% on their return on capital. So when they have their debt and their equity, they're averaging losing 5% of that per year. Cost of capital is 6.8. So they have a negative spread of averaging losing about 12% in economic value as an entity every year. So that is not a good sign. So we looked at their revenues. They are going up, but they're not the most consistent. Same with profit. Gross margins, gross profit is going up, but not quite the same rate as revenue, which means the cost of business is going up, but they're not able to push those costs to the customer. They have to absorb some of those costs. So that's hurting them. And we see that profit, they did have 1 year of profit, but then the next year that profit went down about 50%. So things aren't looking very strong, especially when you consider the debt to equity and the fact that they're not returning any money to the shareholders as far as their capital is concerned. So let's look at the valuation and see what this says to us. Now we have a 17% estimated growth rate over the next 5 years. I believe this is reasonable given what's going on with tariffs. I think there's going to be more demand for used cars, but highly competitive industry. We can go anywhere to get a used car. We don't have to use Carvana. So I believe 17% is a decent estimation there. The discount rate, I would say just leave it at their cost of capital. 6.8 is their hurdle rate that they have to clear to begin increasing their economic value as an entity. 10 times free cash flow. If I were to buy the stock now and sell it in 5 years, I expect I can get at least 10 times the free cash flow amount as far as the shares coming back to me. So the market value should be at least 10 times the free cash flow. For reference, they're trading right now at 89 times free cash flow. Now, I believe the stock is well overvalued, so I'm not really paying attention to that. Looking at the share price at 343, I estimate the intrinsic value to be at about $85 per share. So we're looking at about a 75% downside according to the price right now, according to this valuation compared to the price right now. So fair value range between $77 and $94. So I believe this company is grossly overvalued. As we walk through the fundamentals, there's not a whole lot of stability and longevity there to convince me that this is a premium stock and worth a premium price. Not at all. I think this is a highly competitive space, and they have done some restructuring. They have cut some costs, and they have regained investor confidence, but I'm not really seeing that in the numbers, so to speak. Just a lot of times when companies are making a loss year after year, when they first make a profit, that stock typically surges because a lot of people get excited. They're finally reporting a profit. But that doesn't mean that this company is out of the woods yet. It doesn't mean that they're stable. And I like to see a longer trend of profitability just because there's so many businesses out there with many years of profitability and cash flow that if I invest in them, it's a whole lot less risk. And investing at this company at this price, I think that you're looking at a lot more risk than there is reward based on the fundamentals of the business. So that's my take on Carvana. Let me know what you guys think in the comments, and I hope to see you in the next video.